Could your next step onto the property ladder lead you into a financial quicksand deeper than what we witnessed in 2008? Back in the early 2000s, right before the crash, we saw a housing bubble fueled by easy loans and sky-high property values. Fast forward to today, and we're seeing house prices rising once again, reaching unbearable heights. In the past year alone, home prices have skyrocketed, with some areas seeing increases of over 20%. But this isn't just about the price tags on those for sale signs. Mortgage rates are climbing to levels we haven't seen since the days of the housing bubble burst. To put it into perspective, average mortgage rates have jumped from around 3% to over 6% in just a few short years. This doubling of rates is squeezing potential buyers out of the market and making homeowners clutch their existing lower rate mortgages like lifelines, afraid to dive back into the market. But why does this matter? Well, history has shown us that what goes up must come down. The rapid increase in home prices paired with the spike in mortgage rates is creating a bunch of conditions very similar to those that led to the 2008 crash. The question on everyone's mind is, are we headed for a repeat, or can we navigate our way through this storm without capsizing? Please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, back to what I was saying. Is the dream of homeownership turning into a potential nightmare for millions? Lessons and legacies. Remember the chaos of 2008 when the dream of homeownership turned into a nightmare for millions? Let's step back into that period and see what exactly went down. In 2008, the world witnessed a financial earthquake that shook the very foundations of the global economy, with the epicenter right in the heart of the American housing market. So what happened? The answer starts with 3 words: subprime mortgage crisis. Banks were handing out loans to just about anyone, even those who couldn't afford to pay them back. Imagine giving a high school student a credit card with no limit. Sounds like a disaster waiting to happen, right? Well, it was. By the time the dust settled, more than 3 million Americans had lost their homes to foreclosure. The crisis led to a loss of trust in major financial institutions, pushing global economies into a recession. In the United States alone, unemployment rates doubled, reaching an alarming 10%, and the stock market plummeted, wiping out trillions in wealth. But it wasn't all doom and gloom. This catastrophe sparked a wave of changes aimed at preventing history from repeating itself. Enter the Dodd-Frank Act of 2010, a reform that put tighter reins on banks and introduced measures to protect consumers from risky financial practices. So what's the lesson here? It's that unchecked optimism in the form of easy loans and speculative investments can lead to devastating consequences. But it's also about the resilience and reform that follow the fallout. Red flags and warning signs. Are we sailing into a perfect storm in the real estate market, blinded by the same lights that led us astray before 2008? The numbers we're seeing today might just give us a hint. It's not just about homes costing more, but also about the seismic shifts underneath these changes. In the last year, we've seen housing prices not just inch up, they've leaped. In some cities, prices have surged by as much as 30%. But that's not even the most jaw-dropping part. The number of homes for sale is hitting record lows in some states, making the dream of homeownership feel almost impossible for many. Why? Because while demand is sky high, the supply of new homes just can't keep up. And here's a statistic that might make your head spin. Despite these hurdles, the appetite for homes hasn't waned. Home sales, while slowing, are still happening, but the pace has changed. Homes that used to sell in days are now taking weeks or even months to find a buyer, creating a sense of unease and unpredictability in the market. Beyond the surface. Ever wonder why the health of the real estate market matters to just about everyone, not just those buying or selling a house? The truth lies in the numbers that don't often make headlines but affect us all the same. First up, inflation. Over the past year, inflation rates have soared, reaching levels not seen in decades. What does this mean for you and me? Essentially, our money buys less, from groceries to gas, and yes, this wave hasn't spared the housing market. The cost of building materials has skyrocketed, pushing new home prices even higher. Unemployment rates have also been a roller coaster ride, reflecting the economy's struggle to stabilize in uncertain times. High unemployment means fewer people can afford homes, which should theoretically cool the market, but here's the twist. The job market is rebounding, yet the housing market remains as turbulent as ever, suggesting other forces at play. And what about the overall economy? GDP growth is a measure of economic health, indicating how much we're producing and earning as a country. After taking a hit, the economy is picking back up, but the recovery is uneven. Sectors like technology and finance are booming, yet many are left wondering when they'll feel the upswing. With inflation on the rise, a recovering job market, and a GDP that's bouncing back, why does the housing market seem not to be improving? It's a complex puzzle involving supply and demand, consumer confidence, and yes, those ever-changing mortgage rates. Understanding these economic undercurrents is crucial. They're the force behind the waves crashing into the real estate market, shaping the landscape for buyers, sellers, and everyone in between. The role of government policy and regulation. Have you ever thought about the invisible hand that guides the real estate market? It's not just supply and demand, it's also the government's policies and regulations that play a pivotal role. These decisions affect the market as a whole, impacting everything from the interest rates on your mortgage to the availability of homes. Take, for example, the Federal Reserve's interest rate adjustments. These rates influence how much banks charge each other for overnight loans, but their impact goes much further. When the Fed hikes rates, as we've seen with an increase from nearly 0% to over 1.5% in a recent surge, the cost of borrowing skyrockets. This means higher mortgage rates, making it more expensive for you and me to borrow money to buy a home. But it's not just about the rates. The government's housing policies also come into play. Consider the tax incentives for first-time home buyers or the regulations around lending standards. These policies aim to make home ownership more accessible to more people, but there's always a balance to strike. Too lenient, and we risk another crisis like 2008. Too strict, and buying a home becomes a distant dream for many. And let's not forget about government spending on infrastructure. Investments in roads, schools, and utilities make certain areas more attractive to live in, thereby boosting the local real estate markets. But these projects need funding, often through taxes or government debt, which can have their own economic repercussions. In the current climate, we're also seeing a significant focus on housing supply. With a housing shortage gripping many parts of the country, the government's role in encouraging new construction is under the spotlight. Policies that streamline building approvals or provide incentives for developers can help alleviate the crunch, but navigating the interest of homeowners, buyers, and builders is a delicate dance. So what does all this mean for the average person looking to buy or sell a home? It means that the decisions made in the halls of government can have a direct line to your front door. Whether it's the interest rates on your mortgage, the tax break that makes buying more feasible, or the new park that makes a neighborhood more desirable, policy shapes our real estate market in fundamental ways. Recommendations and critiques. Have you ever wondered what happens when the government decides to take a step back from the housing market, trusting more in the power of free markets to find balance? Let's break down this idea with some simple math and facts, without diving into any political playbook. Imagine a world where fewer rules mean builders can construct new homes faster and cheaper. The theory here is pretty straightforward. If we can cut through the red tape that slows down building houses, more homes get built. When there are more homes available, prices could start to cool off because the supply is catching up with the demand. Tax breaks and incentives for buying homes can put more money back in people's pockets, making the dream of owning a home a bit more reachable for many. For example, if you get to keep more of your money instead of paying it in taxes because of these breaks, you might be able to save up for a down payment faster. Interest rates are a huge deal too. They're the price you pay for borrowing money. When these rates are kept in check, it means people don't have to spend as much each month on their mortgage. Over the past couple of years, we've seen rates as low as nearly 0%, shooting close to 8%. Keeping these rates reasonable helps families afford homes without breaking the bank. Fiscal responsibility plays a big part too. When the government watches its spending, it helps keep the economy stable. A stable economy makes people feel more secure in big decisions like buying a house. It's all connected like dominoes. Knock one over with a bad decision, and it could start a chain reaction. But it's not just about making it easier to buy homes. It's also about looking ahead, using technology to build better, more affordable homes, and making sure there are enough houses, not just in big cities, but everywhere. So what's the bottom line? If we can make more homes available, keep interest rates reasonable, and give people a bit more breathing room with their taxes, it might just be possible to make owning a home more than just a dream for many. Impact on homeowners and potential buyers. Ever wondered how the roller coaster of the housing market affects you, whether you own a home or are dreaming or buying one? For those owning a piece of the American dream, the rise in home values might seem like hitting the jackpot. But here's the twist. If you're not planning to sell your home and cash in on that increase, the rising market value also means your property taxes might go up. More value, more taxes. Now let's shift gears to those looking to buy their first home or maybe upgrade to a bigger space. With home prices soaring, the entry ticket into home ownership is getting pricier by the day. And when you factor in the mortgage rates doubling from what they were just a few years ago, the monthly payments can reach the sky. For many, this means that a dream home remains just that, a dream. Due to the high prices and mortgage rates, only 16% of Americans still believe it's a good time to buy a home. But for those thinking of selling, it's a golden era. Homes are spending fewer days on the market, and sellers often receive multiple offers above their asking price in some states. However, once you sell, stepping back into the buyer's shoes can be a shock with the current prices and rates. So whether you're building equity in a home you own or saving every penny to buy one, the state of the housing market touches everyone's lives in profound ways. It's a complex puzzle where timing, location, and preparation can make all the difference between securing your spot on the property ladder or waiting for the next rung to come within reach. A hidden crisis. Thinking of renting a place while waiting for the perfect moment to buy? You might be stepping into another storm without even realizing it. In cities across the country, rent prices are on a steep climb. Over the past year, renters have seen their monthly payments jump by an average of 15%. Why? It's all connected to the challenges in the housing market. With more people getting priced out of buying, demand for rentals has skyrocketed, pushing prices up. The median rent for a one-bedroom apartment has now crossed the $1,500 mark in several major cities. And if you're looking for more space, be prepared to shell out a lot more. For many, this means allocating a larger chunk of their paycheck to cover rent, squeezing budgets, and forcing tough choices between rent and other essentials. For landlords and investors, the rental market is booming. Properties are rarely sitting empty, and the rental income is higher than ever. However, this golden era for landlords adds another layer of complexity for those dreaming of home ownership. The high rental yields encourage investors to buy up properties, further reducing the supply of homes for sale and keeping prices high. So what does this mean for the average person? If you're renting, it's a tightrope walk between managing rising costs and saving for a future home purchase. And for those on the sidelines of the housing market, the dream of owning a home seems to drift further away as both home and rent prices soar. Future predictions. Curious about where the housing and rental markets are headed next? Economists and real estate gurus are scrutinizing every number and every trend, trying to forecast the market's next big move. Here's something to ponder. Despite the current turmoil, there's a surprising consensus that we might not be heading for a crash, but rather a cooling off. Yes, you heard that right. The expectation is for growth to slow down, with home price increases expected to taper to more sustainable levels. Think single-digit growth, rather than the double-digit spikes we've been seeing. But let's break it down with some numbers. Predictions for the next year suggest a more modest increase in home values, around 5 to 8%, a stark contrast to the 20% jumps in some areas over the past year. Mortgage rates, the heartbeat of the market, are also expected to stabilize, with some forecasts even hinting at a slight decrease if inflation starts to cool off. For renters, there's some hope too. As the frenzy around buying homes starts to calm, the pressure on the rental market is expected to ease up a bit too. This doesn't mean rent prices will plummet, but the pace of those increases could slow down, making it a bit easier for renters to catch their breath. However, there's a twist in the plot. Supply and demand still rule the roost. With new construction lagging behind the demand, especially in popular urban and suburban areas. The competition for homes, whether buying or renting, remains fierce. This underlying tension suggests that while we might see a cooling off, the market won't suddenly become a buyer's paradise. So what's the takeaway from all these predictions? It's a mixed bag. For potential buyers, patience might pay off in the coming years, with opportunities emerging as the market adjusts. For sellers, the days of sky-high offers might not be over, but realistic pricing could become the new norm. And for renters, relief is on the horizon, albeit slowly approaching. Thanks for watching, and please make sure you subscribe if you enjoyed the video and watch this one as well.